Thank you, Greg. Let me just bring up some slides. So, like you said, DeFi has really kind of emerged very quickly, kind of taken the world by surprise, candidly, with not only the speed of adoption, but kind of what it can do in the real world. So I think it is helpful to just spend a couple of minutes to kind of go over at a high level. What is DeFi? What are the characteristics of DeFi? What makes something quote unquote DeFi versus just Bitcoin, for example, and then of course some case studies. So first of all, let's just start with traditional finance. So going back 10,000 years, there's borrowers, there's lenders, and there's a trusted intermediary that facilitates that transaction, be it the local market in the middle of the village. Fast forward to today, and we've got trusted institutions like Chase, Bank of America, et cetera. And that's how it's worked, like I said, for thousands and thousands of years. So what does DeFi do? Well, it's really a technological innovation more than a pure financial innovation. So with the ubiquity now of the internet, the function of actually decentralizing that trusted intermediary is possible. It's not easy. That's the so-called, the famous Satoshi white paper talks about how you can basically programmatically replace the trusted intermediary using consensus mechanisms and quote unquote Byzantine architecture and things like that. So the math is very complex, but the function is the same. It's just basically distributing the trust across thousands of computers globally. So now you no longer have to rely on the man in the market or your local bank to facilitate secure transactions with somebody that you don't know. That's important. And like I said, what's interesting here is this, this really is a technological innovation that just happens to be disrupting finance. So, the analogy is this isn't terribly dissimilar in form or function to, a local credit co-op that's owned by the depositors or things like that. This is just now, and finance is kind of a natural place to be disrupted first, but as we'll get into some of the case studies at the end, it's certainly not going to be the only one. So what are some key characteristics of DeFi? Well, of course, the first one is just decentralization. And at first, this doesn't seem really like that big a deal, or, it's tough to sometimes place, well, why is, the fact that something's decentralized, that's fine, but why is that so revolutionary? But when you start to get into the kind of the specific bullet points, it becomes more apparent. The first is it's self-custodial, which means users are in control of their own money, their own wallets at all times. Now, this brings with it risks, particularly hacking risks, which we talked about last time around. When you can no longer rely on a custodian, or then you have to take the onus of security much more seriously. And there's some technological challenges with that. There's groups that solve for that. But for those that want complete, freedom over the internet in terms of what they can do from a programmatic or financial perspective, the ability to self-custody is really crucial, and really allows for, frankly, speed of transactions. The fact that it's trustless, again, this is a function now of the actual blockchain architecture, the so-called double spending problem. This is the math of how the nodes communicate with each other in such a way that they can provide a consensus mechanism, much like a trusted intermediary would, but without the parties having to know each other or the consensus mechanism itself. So it really is a fascinating innovation. It's not something to be taken lightly, but as Greg and I were talking a couple of weeks ago, this is kind of like the ATM machine. I don't have to know how it works on the inside. All I have to know is, the rules of engagement. You put your card in, you type in your PIN number that only you know, and then you get the money out. So this is very much the same way. Your wallet, you have a PIN number, so to speak, and you're self-custodying your wallet, much like you're self-custodying your ATM card. So again, this isn't some new financial innovation so much as a technological one. It's fast. When you cut out the layers of middlemen, it is very fast. I gave an example where I had to make an international wire transfer a couple of weeks ago, and I couldn't do it on Bank of America's website. It literally said, it didn't throw an error. It said, please come into the branch. So I had to go into the branch and stand there, for 40 minutes to get this done. Whereas, to do that over the DeFi landscape would have taken minutes to anybody on the planet. The Economist, actually, I highly recommend The Economist this week has an article. Their cover page actually is about the promise of DeFi, and they make a good example that so much of the power and the promise of DeFi is the fact now that all it takes to connect is a wallet, which is very simple. Think of that as your ATM card, your digital ATM card, and then internet, which now they make the point, even a Masai Bushman in Africa has access to an internet on a smartphone. So it really does open up access in a way that is just unprecedented. You no longer have to, for hundreds of years, HSBC would brag about how many branches they have in Africa. Now just imagine if that could be digitally replicated on the blockchain, and it can. There's actually a lot of really interesting projects going on in Africa. Last thing I'll say is DeFi markets operate around the clock, 24/7, 365. Oftentimes, if you listen to podcasts with engineers or software developers, they talk about censorship resistance and fault tolerance. They're not talking about censorship in the First Amendment perspective. They're talking about censorship from an informational perspective. People can't decide what code gets run when. Anybody that was around Wall Street in 2008 knows that a lot of banks changed the terms on hedge funds any given day of the week in terms of what margin rates were, what collateralization rates were, how much money could be taken in or out or moved. If on a censorship-resistant system, the rules can't be changed. And so a couple of months ago, there was a sell-off in crypto markets. It was precipitated by China cracking down on Bitcoin miners. And a lot of these centralized crypto exchanges went down. Just simply, they couldn't handle the load. And a lot of the DeFi exchanges, so we'll talk about some specifics, but these are literally applications that provide the same exact utility as a crypto exchange. They just happen to be deployed using smart contracts on a blockchain in a distributed fashion. They didn't go down. They demonstrated a huge resilience that, frankly, the centralized exchanges failed. And so that was a really interesting real-time test of, the stress test of the utility of DeFi, beyond just adding innovation to our lives, but actually also, protecting the gateways of capital. Some use cases I'll get into. I'm going to go through this slide quickly, but the use cases are many more fold than people often realize. Finance is kind of the easy low-hanging fruit. Borrowing and lending functionality, exchange functionality, insurance, options, derivatives. But I'll show a slide at the end. This is disrupting supply chains in a huge way. Provenance with fine art, title, things like that. I mean, NFTs. If you think about NFTs, non-fungible tokens, all that means is that each one is unique, as opposed to something like a US dollar or a Bitcoin, which is fungible, can be swapped out. Well, guess what else is unique? Houses. So an NFT, your deed to your house or your title to your house can very easily be digitized as an NFT and would have infinitely more security than a title record at a local, stored at a local municipality. So anyway, the point being is that the use cases are extending very quickly beyond just finance. One example I like to give is Uniswap. So back to the point about centralized exchange, Coinbase, of course, being the most popular, and then its decentralized counterpart, which would be Uniswap, the most popular. What's interesting is, from an investor perspective, when you put your asset manager hat on, a lot of people it's very difficult for some people to kind of conceptualize the utility or the value of Bitcoin. I mean, we still get this question today. What gives Bitcoin its value or Ethereum its value? Now, of course, the answer is it's the highway on which, or the rails on which these applications run. But, many people are shocked when I go through this example and say, these DeFi protocols are just like companies. The only difference is, they're governed more like co-ops, decentralized co-ops, back to the point about, the local SNL thrift. And so something like Uniswap, they make real money. Make no mistake, just because there's no office, no centralized office, doesn't mean that it doesn't provide real world value and it doesn't make money. It does. And so the question is, well, how do those economics work? Well, that's the governance token. There's a Uniswap token that you can buy on Coinbase, actually, that gives you a share, gives you a vote in the governance structure, including the economics. And that varies by protocol. And so much of the way that you can own stock in Coinbase, and depending on the type of stock, you can presumably have a vote in the governance as well as a share of the economics. These protocols are no different, and that's important, because that all of a sudden now the value types, or the fundamental types, can start to do things like discounted cash flow analysis. You can back out price to sales or price to earnings ratios, and oftentimes when I go through that exercise with folks, they're shocked at how cheap on a price to sales or price to earnings ratio many of these protocols are. What are some use cases? I love this slide because I'm surprised every time I look at it. So like I said, it's not just finance. Supply chains is a very real one, and that's exploding. And there's quietly very big companies that have been operating on blockchain supply chains for years. IBM, Walmart, actually, both of them working with a group that we know and like a lot called Origin Trails. Healthcare is a phenomenal example. I mean, when you think about the amount of healthcare costs that are spent on just administrative costs in the U.S., I think it's over 20%. What better way to digitize in an immutable fashion healthcare records than blockchain technology? Part and parcel with that is identity tracking. The United Nations actually has a project with a certain protocol for refugee tracking, as a way to again, more seamlessly and efficiently track folks across national boundaries and things like that. Again, remember, all you need is an access point to the internet, which is ubiquitous at this point. Music is another really interesting example. Royalties. There's a protocol out there called IDX, which actually just signed a deal with TikTok. And when you think about the music industry, I was having a conversation with an institutional investor about this 2 days ago. The music industry has long been fraught with complaints from the artists about how it's unfair, how power is centralized, among kind of the institutional layer, the company layer. And so imagine something as democratic as each song being an NFT, and then to stream that song, to own that song, some portion of that goes back to the artist. You can completely cut out the middleman. So anyway, the point is that the real world use cases. We always encourage people to think about this as DeFi. Yes, it's short for decentralized finance, but really, open up the thinking a little bit. Think about this more of like the internet. In the early to mid 90s, and e-commerce was kind of the first easy way, low-hanging fruit for disruption, but it rapidly expanded into quite literally everything in our daily lives. And so DeFi is really, or blockchain technology to be more accurate, is really that next step in the innovation. And again, finance just happens to be the easy low-hanging fruit. So with that, nothing else on my end. Hopefully that was
Perfect.
a good overview.
That's fantastic, Ben. Now, when we think of DeFi, it's not that we haven't experienced the concept of the democratization of either financial service products or the democratization of access to capital. You talked about the ATM. I mean, to some extent, the ATM was an ability to democratize the access to cash, right? Or the credit card was the ability to make transactions without cash. You can imagine how powerful that was. So, as we get our heads around this, it's not like DeFi or decentralized finance isn't something that we've benefited from. The democratization of information and the ability to make transactions, buy and sell financial products, in this case, financial products, we've been dealing with that for decades, and whether Schwab and Robinhood helped democratize certain aspects of our financial life. So DeFi is really nothing new. And you and I were talking, and the concept of blockchain is going to touch many other types of call it projects. You talk about sort of these supply chains. Right now, it seems to be focused on everything from mortgages and lending and borrowing and payment. But you mentioned something interesting right now. Titles could be in there. I was thinking as we talked last about the reservation systems when you reserve on an airplane or something like that. Tell me a little bit about some of the other interesting projects. And then those projects are and I'm going to throw a secondary question out there because you mentioned it. Those projects, if you will, whether they're large industry sort of impact or they're subject to a very discrete supply chain, those projects are wrapped up in the token. And so when you own a stock on Coinbase, the token is not only the facility or the programming to do the business, but it also can define the ownership. So talk a little bit about some other interesting projects that you mentioned just recently.
Yeah, really, like you said, the supply chain ones are super interesting because the impacts. I mean, we've been dealing with it. I mean, the globe, post-COVID, the globe has been dealing with massive supply chain shocks, and so and that's an industry that's already fairly well advanced, from a tracking perspective, from a technology perspective. But the example one of the Origin Trail guys gave me was, imagine being able to trace. Going into Starbucks, and as soon as you get your cup of coffee, you can scan a code unique to that exact cup of coffee, and you can trace the exact path for all the way from the coffee bean and the farm in Sumatra, Indonesia, through the processing plant in either Europe or America to all the way to that cup of coffee, and then being able to even tip that farmer. And I thought that was such a fascinating example, and it raises a good question too, which actually you brought up about potential ESG considerations, which is interesting. But so and I think you hit an important nail on the head, which I want to go back to and reemphasize is, it's not something new. It's a natural evolution of technology, and so like you said, the ATM was your example, which I like. That was kind of a very early example of, democratizing physical access to money. You no longer had to go to a central, a central branch. You could go to these, these little kiosks and take out your ATM card. Credit cards is another great example I like for a separate reason. Is, first of all, it was, for many people, I used to work in American Express. So there was all these interesting examples of the early days of credit cards, and people thought it was funny money and it wasn't real, and how do I know it was backed by something, and of course it's how do I know that my credit term is safe and things like that. But what was also interesting too was the credit card industry actually introduced the idea of airlines miles or membership rewards points, and I think in many ways a lot of these DeFi governance tokens kind of trafficked in a similar vein, where for actually using the credit card, you got membership rewards points, which then conveyed their own value. So for a lot of these protocols, especially the exchange ones, you actually get governance tokens awarded to you for using the platform. So currently, for example, Compound is a platform that was one of the very early protocols to facilitate borrowing and lending. So very simple, but very useful. You can go on there, you can stake your Bitcoin, you can borrow against that, which is hugely useful. I'll give a perfect example is, people have been on there and said it's been so difficult to get mortgages that it's actually easier to borrow against their Bitcoin, since they intend on holding it forever, and then just paying down a mortgage. There's no paperwork, it's permissionless, everything is governed by the protocol and the smart contracts, including the collateralization ratios, things like that. And something like that, you think about disintermediating. Anybody who's bought a house or applied for a mortgage or refied a mortgage knows how much paperwork there is for a function that can completely be replicated using code deployed on a decentralized blockchain in a very safe and secure way. And so my point is, back to that about the Compound is, they reward the Compound token. You can go buy it, but you can also get it from using the platform itself. So anyway, back to your point, these innovations, we've kind of seen breadcrumbs of this over time, and DeFi is really just the compounding of these innovations, now deployed to traditional finance.
Right, and to distill that down, that would be like if you're an owner of Apple stock, and when you used more of the Apple products, you would get some shares in return. That would be similar, because to some extent these tokens represent not only the programmable currency, if you will, that delivers an outcome, but the protocol would define what ownership you own of whatever success occurs. So there was a question, and I'm not sure this is if I'm asking the question correctly, but there is a distinction. So Ethereum is the programmable, if you will, money that is used. So it really has two characteristics. It sort of embodies the workflow or the intent. If there's a website, or if that website sort of embodies the business, that is specified in the protocol when it's in the project or in the token that uses Ethereum. Would that be correct?
Exactly. So you can think of, if you go to, in the early, .com is a perfect analogy. So, we had the explosion of the quote unquote internet as a utility, as a backbone, but then there were different companies, there was Amazon.com, there was Pets.com. And so when you go to Amazon.com or Pets.com for that matter, that's a website that you're interacting with. They each serve a different purpose. If they're both publicly traded, they each have their own stocks, but they're deployed on, web servers somewhere. These days it's oftentimes AWS or Google Cloud. So swap out the AWS for Ethereum. Ethereum is the backbone layer, the infrastructure layer, and it's deployed on thousands of computers, including some of our own, across the globe. And so when you write when you want to deploy an application, you write code just like the web developers would for Amazon.com or Pets.com. Except instead of deploying it on a server on a server cluster somewhere, you would deploy it on the Ethereum blockchain. And what's interesting too, and I kind of glossed over this, is all of this is perfectly transparent. So back to the point where Compound is a good example, when I said the rules of the game don't ever change. So I know exactly what the collateralization ratio is, what the what the terms of the loan are going to be. And I can choose to participate or not, but I don't have to worry about those terms changing. And like I said, that's a bigger problem than people realize. And so what that also means is you can go look at other protocols and really understand to a perfect degree of precision what they're going to do, what they should do, including what the vulnerabilities are. One thing we haven't talked about is the risks of DeFi, but there is non-trivial risk to some of these newer protocols where there might be unintended vulnerabilities in the code. But yeah, that's exactly it. Is Ethereum is the base layer, the infrastructure layer, and then different apps that are optimized for different things, different functions are deployed using smart contracts on Ethereum.
Right. So in essence, it's really, and I'll throw it back to your expertise, part of what drives either making a good investment or understanding where your investment dollars are going when you buy a token or project. That's kind of where you guys come in. Tell me a little bit about what you're looking for when you're evaluating a project or a token, and what do you think, because clearly it's the expertise of being able to go through those protocols, right, and understand ultimately how that technology works, and then where the outcome is. What is it that you're looking at when you look at these things, either 5 years ago, 2 years ago, and then today?
Yeah, it's an excellent question, and it's an important one too, because when you're looking at Bitcoin and Ethereum, first of all, they've both been around for a while now. They're battle tested, and so the risk there is unless there's a 51% hack, which is theoretically possible, but practically speaking impossible, the real risk with either one of those is just the volatility, which is non-trivial. When you start getting into these DeFi protocols, they're much newer. Again, they're deployed. There's a distinction because they're deployed most often on Ethereum blockchain, but now you're starting to see some other so-called layer one chains starting to host applications. But that's where there's an entirely new risk vector, and it's around the smart contract code. And so to really prudently participate in that space as investors, you have to be mindful of that code, what it says, what it does, the user base. I mean, we get involved in the developer communities on Discord, talk to users. We want to see a critical mass of adoption in the protocol first and foremost before anything. It needs to have been around for some minimum viable time, because again, oftentimes if there's vulnerabilities, it's going to be they're going to be washed out in the first few months. We also spend a lot of time, remember, back to the point about transparency, we can see other wallets. So we can see to what degree there's institutional participation in certain protocols, which again, we generally like to see. Bain Capital, owns a couple $100 million worth of compound tokens. That's a compelling indicator for folks like us. So they don't own enough to control it, but they have a big enough stake that that's another set of eyes looking at it as well. And then you just have to get into the nitty gritty. I mean, we have Solidity programmers. Solidity is the language specific to Ethereum that smart contracts are written in. And we, including myself, will go through protocols line by line, look at the code and look for vulnerabilities. And we have found, there are protocols in indices out there that have known vulnerabilities, that never in a million years would we ever, invest in. But they are big. So they meet certain, if you're only looking at market cap, it might show up in your screen. But, if you're looking for, backdoor migrating functions, you throw them out. And so it's a non-trivial effort, and it's very much a programming one. It's a very different kind of function than a traditional quantitative asset manager, where you're spending all your time modeling risk, thinking about risk from a statistical perspective. Now you need to get into the quote unquote real world of programming and understand bugs and vulnerabilities and things like that. So it's we're very careful when we talk to new investors in this space that DeFi is interesting and it is going it is going to be nothing short of revolutionary, similar to the internet. But it's don't necessarily just get a MetaMask wallet and start going out there buying every hot tip on Twitter, because just like pets.com went to zero, a lot of these, even if there aren't vulnerabilities and they're not frauds, they may not get adoption, or there's still risks out there. So it's
right.
It's a different exercise.
And I'm an old dog in the investment business, though it reminds me of covenants and bonds, and having a good bond analyst or a credit analyst to really understand sort of the flow of where things go, and making sure that there's no risk, if you will, to the bond holder. In this case, it would be very similar. The smart contract really does design exactly how decisions are going to be made quickly. Now, it's the benefit to society, and we'll roll into a little bit of ESG because I find it very fascinating. The benefit to society, and we talked about ATMs. Clearly, in the old days, who was going to pay $3 to get their own money out of an ATM? And then, as ATMs become more ubiquitous and this technology, this blockchain becomes more ubiquitous, the idea is that it squeezes costs out of the system. So this technology should be deflationary because it's really trying to create transparency where there is opaqueness. When I think about the future, about how investors, particularly some of the we talk about millennial investors, there are going to be things that are more important to them. So these smart contracts may actually have things in there that are more important to them, like these ESG type of things, and even maybe even large investors, as they start thinking about where they're going to deploy their money. Large institutions say, look, we're going to buy stock, but there has to be some type of ESG component. The same thing would be for a token or a project. You could code, if you will, very specific ESG rules, and the investor could count on it because, as you said, it's in stone.
Exactly. Yeah, you hit on a couple of really important concepts I want to highlight. The one was covenants. That's a perfect analogy. If we go back to 2008, the financial crisis of 2008, particularly in the debt landscape, the investors that made it out alive or actually thrived were the ones that really went through the covenants on these CLOs and understood exactly what each tranche held. And in retrospect, you see movies like The Big Short and things like that, and you say, "Oh my God, who's going to do all that?" But that's what it took to avoid that crash, at least from a credit perspective, and even capitalize on it. And so it's a very similar analogy. I mean, these smart contracts are the covenants. And then your point about being able to kind of codify certain traits in there, I think is hugely important, because the younger generation is really driving the ESG boom. And groups like Robinhood that have kind of delivered technology to facilitate impact-based or social-based investing on very personal criteria. It stands to reason. We haven't seen it yet really, but some of those projects we've talked about, like the United Nations one, or even the supply chain is another perfect example, is perfectly set up to take into account or to optimize for ESG considerations. One of the things we've seen, we actually work very closely with Owl Analytics, which is one of the leading ESG score providers, and we've done some consulting projects for institutional investors. And one of the issues with ESG in general is that depending on what matters, the E, the S, and the G can be very different in and of themselves, and oftentimes they can be at odds. And then depending on whose criteria you're using to calculate the E, the S, the G score, the same company can have wildly different scores. And something that may score very highly on low carbon footprint, like many technology companies, may score very low on human rights violations and things like that. And transparency is one of the biggest issues there. We had a call with an AI firm a couple of weeks ago about this exact issue as it relates to ESG, because it's just so difficult to get all the information. Well, imagine if something like the supply chain was available on a distributed ledger that couldn't be corrupted, that was immutable, and you could see, okay, this is this vendor really is sourcing fair trade materials, and or these diamonds really are coming from the appropriate mines that aren't conflict diamonds and things like that. Then there's the confidence interval around that ESG score is much lower, but the contract itself, to your point, which I think is kind of a brilliant potential application of smart contract technology, that could easily be represented within a smart contract, such that certain governance tokens could only show up in certain wallets or certain other protocols based on kind of the constellation of ESG factors. So yeah, those are two excellent points.
All right, I think our advisors, they're very engaged. So I have a question here for you, and I'm going to read it to you, and you tell me what you think here. So the question is, what is the best crediting platform? Which coins would they accept? And if they lend dollars against coins, do I still own the coin and its risk and potential, i.e., can the loan be recalled if the coin drops in value, right? So now you've got a loan based on a value, and then now there's volatility in the coin.
Yeah, so the answer is absolutely. So, I'll give you kind of the two gold standards for borrowing and lending platforms are Aave and Compound. They've been around the longest. They're the biggest. They've both done a good job of kind of building in appropriate institutional layers. In fact, we had a podcast with Ajit from Aave a couple of months ago, where we talked about the work they've done on KYC and AML within their platform. So they are making strides to really attract institutional capital. So it's a good question. So what happens? What coins do they accept? It depends on the platform. The coin list is growing, but it's typically, I think, on Compound, you can stake, as they say, or you can lend maybe a dozen different coins. Bitcoin, Ethereum being the most popular. And then on the borrowing side, generally people are borrowing stable coins, unless you want to short something like a Bitcoin or Ethereum. You could borrow it from there and then pay it back, hopefully at a lower price. So what happens when the coin drops in value? That's an excellent question, and that's part of the covenants that are spelled out in the smart contracts. Now, what's interesting, and so typically there's over collateralization ratios. It depends on the platform, depends on the protocol, but it could be 50%, could be 80%, which means if I put up $100,000 in Bitcoin as an example, and I take out a 50% loan, if the collateralization ratio drops below a certain amount, which you can perfectly see in the smart contract. And by the way, you don't have to go through the smart contracts to see this. I mean, it's spelled out on their site and things like that, but it's easily verifiable on the blockchain. If that collateralization ratio fails, then you instantly get liquidated. But what's nice is that you get liquidated again on predetermined, on predefined terms. So it can't change. And again, this is something in 2008. Anybody that was around in 2008 in a money management capacity, I remember talking to different credit hedge funds, and they're saying, yeah, depending on we're moving money from this prime broker to this prime broker because they're changing the margin rates on us every single day, and we don't know what's going on. If you go back to 2005, I mean, this same thing happened in convertible bond arbitrage space. And so there's a pro and a con here. The pro is that everything is transparent, everything is programmatic. There's no central authority deciding, hey, we're going to hike margin rates. What you agree to in terms of your collateralization ratio and your liquidation terms, are what it's going to be. The downside is you can't stop it once it's set. And so what happened back in May was China came out with very hawkish tone against miners, made it illegal, and leverage is extremely popular among crypto investors in China, even at the retail level, to a tune that is just unheard of here in the West. It's like 100x, 20x, 50x, and so what happened was that kicked off, a price decline in Bitcoin, which then kicked off all these smart contracts liquidating, liquidating these positions. So the counter is, there was no friendly call from your prime broker saying, hey, we're going to have to liquidate you unless you can post margin. It was just a smart contract saying condition A was met, condition B is executing. And so we saw this liquidity cascade of epic proportions, which completely, tanked the price of Bitcoin. So there is some, again, it's not just, it's not all good. It's mostly good, but again, there's no friendly call from your banker saying, hey, you missed a payment, you got to bring it current, otherwise we're going to liquidate you. The code is just executing. So that's an excellent question.
So in that case, there's not necessarily flexibility unless it's coded into it. I'm a chemist by trade, and so certain materials they break and they collapse all at once. Versus having some integrity, like metal and steel has some integrity after a certain trauma. It's interesting because we're in this day and age where there are other things, as you mentioned, blockchain can solve. You mentioned immigration, then you also mentioned royalties, which I find very interesting. I know people have focused on, well, what's the true value of an NFT? The other side of the coin is the true value is that it protects the provenance, if you will, and pays the appropriate people because it can't be replicated or faked or whatever like that. So talk a little bit about that. That really sort of resonated with me. When immigration, you could literally then use that as a very strong tool to quickly process people. If we talk about what happened in Afghanistan, who knows what, where, when, how, this type of technology could really solidify that and allow us to take much better action when it comes to people and process.
Exactly. So yeah. So on the NFT royalties, I mean it's kind of fascinating because again, when the whole NFT thing happened, myself, like many other people, were looking at it just perplexed, like why is a JPEG of a weird looking CryptoPunk trading for $100,000? And so that, I think that kind of clouded a lot of the more interesting utility of NFTs, like that example I gave on homes or title, which actually is an example that came from Ajit at Aave. He said that's, if you think about NFTs as representing very unique financial securities, like a specific home with an address, then, it opens up a whole new world of possibilities. And, the artist is interesting too, so back to Audius as a royalties platform, or, I think the Economist article made another good example about art. Imagine if art, for example, a physical art, and so they gave a famous example of a Warhol painting that he sold, under desperate circumstances for $10,000, whatever, and then however many 30 or 40 years later, it's trading for $80 million, and his estate is seeing none of that. And that's just the way the art world works. The entirety of the ownership transfers from one to the other, as is the case with most assets. But with art in particular, they said it might be interesting if, a portion of that royalty stream or a portion of each sale went back to the artist in perpetuity or for some predefined term, all of which is very easy with, again, smart contracts in the blockchain. And, again, we've seen, I'm very much a dilettante in the music space, but it's been interesting, to observe kind of these music platform wars over the years with the artists, with music rights, and again, you think about something, completely democratizing, the IDX technology, where artists can deploy their songs on the blockchain as an NFT, and then wherever it goes, they know exactly, every pre-agreed upon, royalty stream can flow appropriately, and everybody can see it. The terms are known, and importantly, to your point, the middleman is cut out, which is a key consideration for keeping costs down.
We're coming up to the 5-minute mark. I think to summarize that, what you're saying is that it to some extent creates a more robust system for property rights, right? So to the extent that there are laws and there's a legal structure to protect property rights, you can identify the property rights based on this very bulletproof, call it identification, whatever you want to call it. So we got the last 5 minutes. I really want to throw it to you. What do you think the future is? I know we've talked a little bit about this. You had mentioned to me that there will be winners and there will be losers from an economic perspective. And we talked about how the internet, the first wave of the internet, it was a big thing, and then there were a lot of net losers, right? And then second version was really how the internet is used to affect supply chains. Think of Uber and Lyft and things like that. You see that going forward?
Yeah, I think it's a good question. I think the big winners from an industry perspective are going to be finance for sure, as well as supply chain. I think those are the lowest hanging fruits. I think looking further out, healthcare and kind of I'm going to call ID type tech, like what the UN is doing, the royalties around NFTs, I think are inevitable as well. As in terms of individual protocols, it's just part of staying on top of the space. I mean, it is, I'm old enough to remember the .com boom in the 90s, and it's just staying on top of who's doing what, who's winning, who's getting traction, because it in many ways it still is the Wild West. With great promise also just comes there's going to be a lot of winners, there's going to be a lot of losers. But I do think, from an industry perspective, I mean, this is like the internet. This is every bit as transformational, and even with all the regulation that's coming down the pipeline from the financial side, it's going to be a very democratizing force. Ultimately, it's going to cut out a lot of those middleman fees. I just read something that said something like $40 billion was sent across the border from Mexican Americans back home to Mexico, of which 4% was in Bitcoin because it was easy and cheap. And that's only going to go up. The last thing I'll say is the underbanked population has kind of been, an interesting problem for a lot of years, and I think this is rapidly going to help solve that. Obviously, not in its entirety, but a lot of the early adopters that we saw in blockchain were countries that had to. Venezuela, a lot of these African countries, China. That's why Bitcoin's so popular in China, is because it was a very easy way to subvert capital controls. And so, I think that the financial impacts are immediate and huge, and we'll start to see that propagate through other industries like supply chain, title, ID, royalties, etc.
Now, for you guys at IDX, I know, and I don't know if you can talk about it, but going forward, you guys are going to take your expertise and potentially have a vehicle that will be easier for our advisors to get exposed to your expertise. That's what I'm hearing, correct?
Yeah. So in the DeFi space, we have a trust coming to market very soon. That's going to be based on an index that we created. That's calculated by S&P. In fact, that should be live on their website any day now. And the objective there is, again, is just risk diversification. Generally everything we do philosophically as a firm is one about really endeavoring to take smart risks. We're not trying to avoid risk. We're just trying to take compensated smart risks and help investors do the same. And so the idea with DeFi is, you want to get away from all the existing DeFi indexes out there are market cap weighted, which really presents a lot of problems because the very speculative nature of digital assets as an asset class makes market cap weighting, ironically, a much riskier scheme than it is in traditional assets where market cap is a proxy for maturity of a company and quality. You want to avoid market cap in some cases for things like Dogecoin or this other coin that has this migrator code function that is huge. So this is one about spreading bets. It's risk weighted. The idea is to give prudent exposure to the DeFi ecosystem in its entirety, not just focusing on the borrowing and lending protocols, but really spreading out across the entire ecosystem. As a way to have prudent participation to the space. So yeah, there's more information on our website. That's coming to market in the next month or so.
And as we talked, when we go forward and advisors think about an allocation to this type of investment, it's not really, the volatility and the risk is really akin to maybe more like small cap or private equity. So as advisors think about the allocation and the volatility, would that be how they should view it, or should they view it differently?
Yeah, what we tell people is this should definitely probably sit within an alts bucket. It's a high vol asset class, and even if we can on our risk managed series of products, even if we can expect that volatility to go from maybe 80 or 90% annualized for a long only allocation down to 40%. 40% is still very high. That sits within maybe a commodities landscape. So yeah, what we're seeing is most people are putting it in either a commodities bucket or alternatives bucket. Between 1 and 5% at the very high end.
Perfect. Well, we really appreciate you coming and sharing with us. I know this is your second time, and the feedback we've gotten has been fantastic. We appreciate the education that you've given us. This video is recorded, so any that want to watch it again, we'll email out the links. And again, want to thank you very much, Ben, for joining us and all the advisors that have signed on. So thank you very much, and we look to hear from you again.
Thanks, Greg.